I've tested my Forex growth plan and it has stood up. It has stood up through global financial crises. It's stood up through floods. It's stood up through pandemics, and it is making people a lot of money. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show's a code cracker, that's for sure. We're going to dig into economics and understanding really what the roadmap for real estate actually looks like over the longer term and how the world is being really split in two and what that means for you and your back pocket and how you should be investing. Today, you can invest off a spreadsheet, come up with some mathematical equation, follow some sort of data logic and end up owning real estate. You can equally buy real estate today based on human needs, what human beings are experiencing and where those trends are headed. And today I really want to have that battleground argument because the world is certainly going left, right, and center. It looks like we are being thrown upside down. Today we've got political leaders that dictate really what our world actually is. We all of a sudden are starting to have to consider living in a vaccinated economy, whatever that means. And for a lot of people, Struggle Street is a real street right now. And for that reason, I absolutely am seeing the difference in what was once a normal behavior in the real estate investment arena to buy real estate using investment data and spreadsheets and calculators. And of course, today, a lot of that has been thrown out the window because people simply are absolutely loving the idea of lifestyle and what that means to them. And of course, no spreadsheet can tell you what a place is like or where the best lifestyle is. So for that reason, I think we are going in two different directions. And I want to give you my take on what that may look like for the property world into the future. And of course, what we need to be very, very wary of into the future. There are some pitfalls that we need to understand. And of course, I think asset allocation is probably one of the biggest conversations in real estate right now, and rightly so. All asset allocation ultimately means is what you do with your money. Where do you spend your money? How do you invest in this thing called real estate? You know, the reality is society is on hanging on by a bit of a knife's edge at the moment. It's kind of like you're seeing, for example, the healthcare system under stress. You're absolutely seeing, capital going to assets and assets inflating in value. And of course, for many poor and low middle income earners, they're just not earning enough money to keep up with the costs of goods and services. And I know it feels like I harp on that a lot, but today I really want to make sure you understand really what the inequality freight train is doing to the real estate marketplace and what potentially you need to understand when it comes to future things like perhaps rent control, build to rent, some of the ideas around the command-led economy transferring really wealth to make it more equal. And the reality is today the rich are getting richer. There is no question in my mind that those people I've helped become property investors over the years absolutely are becoming wealthier and wealthier and wealthier. The asset allocation for many of those people who I've helped build and buy 7, 8, 9, 10 properties, I mean, they are up millions of dollars off the back of coronavirus. The average person just is not saving that amount of money to pay for assets in the marketplace. So we are in a strange dynamic at the moment where really we are reliant upon low credit for a very long time now to guide us through the economy. And it's probably fair to say there are some lunatics in charge of the whole thing. And for me, that does not bode well for the wrong asset allocation in real estate. Now, when you think about an economy being command-led, all that means is government has an influence. Government does have an influence in real estate. Government has fundamentally saved the real estate market, if you like. And in a way, government has created the wealth effect through things like creating extra building boosts and stimulus and throwing money at the real estate market to make it tick over, which has been great. And of course, banks have created things like mortgage holidays and so forth. But let's face it, look at the bank share price at the moment. It is huge. They have taken a lot of that quantitative easing money. They have multiplied it and spread it out the economy, and now have more people certainly, borrowing money, which is not income producing money, and not paying for money to create a profit from it, but just to get into this thing called housing. Now, I think real estate is always going to be a bit of a bedrock investment. But if New Zealand is anything to go by, the command-led economy in New Zealand is basically making it virtually impossible for property investors to even exist. And for what I'm seeing in that economy, it's very difficult to, for example, buy a secondhand property today in New Zealand. To buy a secondhand property in New Zealand, banks will lend you like 60%. There's just not enough properties for the population of New Zealand. And when there's not enough properties for the population, inequality happens, real estate assets just balloon in value. And really what's left is a marketplace of existing landlords, renters, and homeowners. And really, if anything, the New Zealand government is almost like trying to stop capitalism by, making it virtually impossible to become a property investor in New Zealand. And those lucky people that are capable of becoming a property investor in New Zealand will join sort of like an established level of landlord ownership, which won't grow as fast as it did in past eras. In fact, it's probably fair to say in 2032, let's call it 10, 11 years from now, property investing in Australia may be very, very different. It actually potentially may not exist like we understand it today. Today, it exists. You can do things like negative gearing. You can get tax benefits from buying real estate. Of course, the Australian government typically has relied on mum and dad property investors to provide properties to the marketplace. And of course, if that shrinks, if people can't become property investors, well, who provides the properties to the marketplace? Where does it come from? How do assets get created for people to live in? And, I'm openly, understanding what is happening. The real estate market is being split. It is being split down the middle, and as such, I do think probably 10, 12, 15 years from now, whereby if people are going to buy property, they're going to be choosing properties that they're buying to use as homes, as opposed to buying a home and rental properties. I mean, the good news around that is if you aren't an investor yet, you absolutely should be, because it is a bit of a ticking time bomb. You're going to run out of time eventually to even join the race. So I think, where we're at the moment is a interesting place with asset values, pretty up there in many, many cities. It's very, very difficult to become a property investor in some cities. Sydney is virtually impossible. In A grade, inner, middle Sydney, you cannot buy real estate unless you're wealthy. Real estate is a rich person's sport in Sydney today. And again, there's a lot of money at the top of the funnel. So those properties where rich people can buy, they just pay more for them. They pay more and more and more and more and more for those properties. They do not drift out to degrade Sydney to buy real estate. So Sydney is fairly unaffordable. I mean, the average person has to spend something like 13 times their income to buy real estate, meaning really once they're in, they can't really become property investors. Even if they got equity, they couldn't borrow the equity. So what happens to the marketplace when it's locked in like that? Well, certainly for a lot of people inside of Sydney, their wealth is trapped in their family home. And really that is their wealth creation strategy moving forward into the future. But what it is going to do is certainly create some ripples as to where this is all going. And I'm pretty militant about understanding that real estate, like society, like the middle class, is also being split in two. And for many of my investors, I love coaching them to buy on the right side of that economic divide, with the idea that we should choose humanistic experiences that real estate offers people over and above the idea of just buying real estate off a spreadsheet. You know, years and years and years ago, 2005, 6, 7, 8, 9, spreadsheet understanding, buying on the numbers was a big trend in real estate. Really, for me, since 2007, I've been coaching a thing called the 4X growth plan. It's a simple plan. I've said it many times on this show. You know, you buy well, you buy a good location, you buy a great marketplace where you can get into that really affordable and livable zone inside a city, and you choose a great piece of behavioral humanistic logic that improves the value. How walkable is the asset? How close is it to transport? How close is it to a beach? How close is it to the park? And it's really today that humanistic experience which people are paying bucket loads for. And if anything, what we have learnt off the back of coronavirus is people are becoming very tribal again. You are actually seeing the tribes move. All of a sudden, people who perhaps have a more familiarity, grew up in the beaches, drifted out, all of a sudden are like, you know what, I've got to get back to my beaches roots because, I know that's a good experience to live in. And you're starting to see, again, economic divisions, people who perhaps have never experienced living in a very livable neighborhood and haven't got the economic capability of living in a livable neighborhood are being shut out. And it is so fascinating to watch that today the Australian property market is very much headed in some different directions, which, again, I really want to flag it in this show that, as a property investor, I'd really love you to walk away into the future owning the right asset. Asset allocation is probably the key principle of property investment today. Sydney is a bit of a warning. It is overheated. It is an expensive place. And if I was to say anywhere was a bubble inside of Australia, it would be Western Sydney. People don't earn a huge amount of money, but they're having to spend a huge amount of money to rent and having to spend a huge amount of money to own real estate in Sydney. I mean, what I love about Sydney is you get to see where extremes are today in the real estate market, and there's no more extreme market than Sydney. Of course, Sydney, people often, reference Sydney as a property market, but, you've got the harbour, the beaches, that's sort of one pocket. And then, Sydney can drift into some pretty ordinary ghetto marketplaces where you just would not want to wake up in the economy of tomorrow with assets in those marketplaces. I think, what we are without question seeing is two types of new rationale coming into real estate. The first one is almost the Japanese style zombie economy coming into real estate. All that fundamentally means back some sort of 20 years ago, the Japanese economy basically went into a bit of a price bubble dynamic in 1986. And, it basically has never recovered. And as such, a few things actually happened off the back of what unfolded in that price bubble. And that was that, you ended up seeing basically that economy never lift interest rates. And Australia is really at this place that the cash rate may move a few percent here and there, but we are now living in a Japanese style kind of zombie marketplace where low rates are here to stay. And, my missus, she lived in Japan for a very long time. I've traveled to Japan. I find it a very fascinating fascinating country. There are so many vacant homes in Japan. It has got like the world record for vacant homes because when that basically bubble went off, people haven't become wealthy in many parts of Japan, and Japan is really a coma economy. And for people who are not wealthy inside Japan, they are the properties they own, the assets they own, they just haven't performed for them. And those people who bought in the right side of Tokyo and the wealthier pockets of Yokohama have all made gazillions out of the real estate marketplace. So we're now in a place like Europe where there's basically, a negative cash rate. We're now mirroring Japan, which is this economy which, will struggle to inflate. And the big challenge around that is basically the older the population gets, the more deflation actually occurs, because as people become older, they generally produce less and spend less, right? And so Australia as well has always fought this challenge of an aging population by bringing more migration into the country. Fortunately, Australia gets a lot of migration, and it kind of saves the marketplace from being too zombie-esque like it is inside of Japan, where you can go through half of Japan and honestly there's just vacant houses everywhere, which makes no sense, right? Because it's, a country of 250 million people with limited space, but actually a great lesson for us to understand, despite the limited space, everyone wants to live where the action is, where the jobs are, where the economy is more robust, where there is fun, where there is action. And, I think that is a critical lesson of what, will unfold in Australia, that all of a sudden the more desirable lifestyle pockets that don't look good on a spreadsheet are absolutely where everyone wants to live. The other, concept that you probably need to comprehend about where Australian real estate is going is the American style of real estate. In America, you can go to New York City and prices are, mental, what people pay for rent, mental. What properties are worth, absolutely crazy, right? There are properties that rent in New York City for $30,000 a month. And again, to buy there today, expensive. But what if you'd bought there, 20, 25, 30 years ago, and you were getting, $10, $20, $30,000 a month in income? Well, really, that's the divide, right? Because most of America, real estate is $100,000 and it rents for $200 a week. It is low cost housing. There is a lot of cash economics in that country. There's a lot of, migrants that basically don't have a green card. So there's kind of like this almost like illegal rental currency in that marketplace. But what it does show is that inside America, there is really a two-tiered market. And where Australia is headed is to a two-tiered market. Assets which are designed for poor people and assets which are designed for affluent people. And today, because of the affordability and livability supply gap, it is getting very, very difficult to find affordable properties that will end up being lived in by the aspirational part of the economy. Now, what I do every day is try and look for these assets because I know that where this is headed, because Australia has been down this road absolutely before, and into the future, we are going to see a two-speed economy. I've mentioned it before. Australia's second biggest employer is Uber. We've got people who spend $200 a night on Uber eating, whatever, the Greek, a Greek Apollo dinner and, Uber drivers sort of delivering it, living in a shared household, doing 2 or 3 jobs. In fact, the amount of people doing 2 or 3 jobs to keep up with the cost of living at the moment is a lot of people, a lot of society, right? So, coronavirus just highlights what was already going to happen. This was already going to happen, by the way. We were always heading for the great deflation of the cash rate. And this is great for property investors if they think positively about it. Maybe I sound crazy and negative, but what I want you to understand is you've got to bet on the right part of the divide so you wake up with the right side of the economic divide, which is unfolding. And, what government is already talking about now is the next rental crisis, which is going to occur because not enough stock being built. There's not enough real estate in the marketplace at the moment. Besides, lockdowns just stopping the velocity of people moving and creating almost like an unofficial vacancy rate in some suburbs. The reality is when things start to flow, when borders start to open, we're going to face a rental crisis. And here's the real squeeze, which we need to be cognizant of, which is happening all over the European Union, is that Australia actually may face the idea of introducing price caps when it comes to certain rental communities or rental properties. And, for me, this has got alarm bells all over it because, much of society is just not keeping up with the Joneses and you can't constantly put the rent up on that marketplace. And there is a tipping point where, we are probably going to see some sort of government intervention from the command-led economy to actually go, rent increases have to be done at, CPI and that's it. And for me, I'm very wary of what this actually means. So, I do not want to be faced with owning real estate in an unaffordable suburb location, which potentially is put onto some sort of heat map, whereby, people in that suburb are on Struggle Street. And as such, we're in a place where, we can't put our rents up and increase our cash flow. So for me, by chasing the livable suburbs, people who generally rent lifestyle are not need-based. And as such, I would imagine certainly the real estate institutes would argue into the future, if there was to be some sort of rent cap, that anyone living in Bondi is doing so because they absolutely want to live at the beach. So as opposed to someone living, 94 kilometers from a major city where they're basically, having to rent because they're on Struggle Street. So I think I'm flagging a lot of this stuff because, this is definitely where this world is headed. And I've seen this before. I've been through many, many property cycles, and I can tell you my Forex growth plan is making people a lot of money. Since 2007, since I really knuckled down and did the Forex growth plan. Prior to that, I was doing a lot of trading. I was doing, buying real estate. I was holding it for shorter periods of time. I was buying using spreadsheet logic. 2007, I made the switch. I went, you know what? There's some great deals to be done. And, I want the best locations. I want the A-grade stock. And I want to buy where things are affordable, but communities are becoming highly livable. And I want something close by to trigger capital growth, things like a tram, an urban forest, just something to kickstart the humanistic experience. And ever since then, I've made a bucket load of money out of the real estate marketplace. But when you think about it, right, like the reality is we've got a number of Australians who have got, 2 jobs. Sydney is an expensive marketplace for many people to live in. For most people, they won't become property investors if they buy a property in Sydney. In Western Sydney, they just wouldn't have the extra servicing to go and become a property investor. So they make their bed, if you like. And this is the interesting thing. So if there's going to be potentially into the future less property investors, which I highly think property investment will end up morphing into a rich person's game, if we buy a property which does not appeal to fundamentally owner-occupiers, we may just end up with an asset which we have to trade and is only worth something to a high-level investor. And this is the big transformation and shift which I'm referring to. And I've kind of alluded to it through the American version of real estate. American real estate, rich people, New York real estate, all the good stuff. People pay good money for it. It's in the millions. And then you've got hundreds of thousands of dollar properties, which, on a spreadsheet would look amazing. The rental returns, the ability to potentially upgrade them all look good. But the reality is, it is just buying into the inequality pool. And as a property investor, if you're selling, there really is no owner-occupier inbound market for those assets. It's really just another investor doing more mathematics and more calculations. And usually that means driving the price down to increase the yield. And of course, if you play in that asset game, you're going to get burnt. And I've certainly done, I've got the lashes on the back where I've bought basically investor stock, which is only suitable to another investor. And when I needed to sell, really, the game, if you like, was mathematics. They wanted a higher return. They wanted a higher return because the interest rates were going up. So to create a high return, because the interest rates were going up, the price had to go down. So again, like if you start to play with this sort of spreadsheet dynamic, it can be a bit of a race to the bottom because Australia's wealth distribution is being, split apart. There's more wealthy people at the top of the funnel than there is, people in the middle class. And really, Australia doesn't have a middle class anymore. And as such, I think we are starting to see a shift between broad economics and behavioral economics. Broad economics is the idea that, we got a supply and demand shortage. We've got a low cash rate. We've got, real, challenges with things like, the vaccinated economy and the lockdowns and all this kind of stuff. It's a broad economic actions. We've got quantitative easing, broad economics. And then we've got behavioral economics, which is some people don't care about any of that and will go and pay $1 million more for the right property in the right location and have the money to do so. And so what I'm really at a position at the moment is that we need to get into these lifestyle precincts to feed off this sort of behavioral economic logic. And, I teach principles around what type of lifestyle to look for and what type of economic influences, whether it's hospitals, beaches, schools, parks, these type of things, are all going to create a positive influence into the future when Australia doesn't see its cash rate move much. When there are less property investors in the marketplace, and you need to guarantee that you're going to be able to sell your property one day into the future to an owner-occupier. So again, we've just got to think through our asset choices at the moment. And I think a lot of people, and I see a lot of people making mistakes when it comes to what they're choosing. They're thinking cheap, cheerful, affordable, decent rental return, that's me. And there is no design logic. There is no aspiration for someone to want that asset. It is just simply a race to the bottom. And what I'm trying to flag here is with the change in economics, we may just end up in a place where, there are the wrong side of the tracks and the right side of the tracks to invest in our cities. We've certainly seen it in regions before. Absolutely seen it in regional markets before, where there is the right side of the tracks and the wrong side of the tracks. Now, if you go to a regional city, you can see it firsthand. There are streets in the regional city where, you'd be too scared to drive down them. They're that decayed, run down, and full of crime. And the prices in those cities or small regional communities have never gone up. They've never gone up. They will never go up. And, that's where we're at the moment. After this asset increase off the back of basically getting more money into the economy, property is going to become niche for capital growth. Capital growth is going to be for the right property, right location. And that's where, again, I've tested my 4X growth plan and it has stood up. It has stood up through global financial crises. It's stood up through floods. It's stood up through pandemics. And it is making people a lot of money. The reason is it's a simple plan. You buy well, you choose a really good location. We look for the affordability and livability gap, where the gap is, where things can improve in value, and be funded by other people's money, being funded by the yield. We look for a market which has still got room for growth without being a bubble. And we look for some humanistic characteristics which are going to influence that real estate. After this growth slows, capital growth will still be available, but it's going to be harder to find for people. And, it's going to be niche to assets. Owning the right property, in my view, has never been more important. Never been more important in Australia. And, again, there is no wage growth. Like, people are not waking up with another $100,000 in their back pocket in the next 5 years to pay for another $1 million of debt. So if that isn't happening, and we are in a place where all of a sudden really the recovery of the economy is geared around getting capital into the marketplace. Once that slows up and there is a period of contraction or things just, cool off, or if money starts to be harder to move around, all of a sudden there's less money flowing, the velocity of the money starts to slow down. Well, you're going to start to see all of a sudden, where have we got to? Have we got money to pay for healthcare? Have we got money to pay for free schooling? I mean, here in Australia, you can go to school for basically free, but it's not free. Someone has to pay for it. And usually that someone or something is businesses performing and capital moving. And again, we've seen this in many other countries where the start of a transformation, also which we're going through at the moment, doesn't always mean that there's going to be, great times, and there'll be tough times ahead. And as a property coach, I'm cool with that. I love tough times. I love helping people through the challenges that they're about to go through owning real estate for 15 years. But we need to get our foundations right. And today, I want this podcast to be really critically aimed at understanding that people have a choice right now. Go out and buy something old, cheap, cheerful in a D-grade location, and do it at your own peril. Or go out, find the affordability and livability supply gap, realign your portfolio, buy real estate, which people will discover, and it will become aspirational. Use other people's money being your tenant to do it. Use the zombie economy of low cash, the lowest cash rate in the history of Australia, and make yourself wealthy. Do it using a humanistic experience, and give up on the idea that the spreadsheet is the way or the formula to use. Now, when I say spreadsheet, I will clarify there are certain things I think you should look for when you're looking for any real estate. But, the reality is a lot of people today are buying real estate without this logic that there is a trend happening at the moment. Today, people are returning in droves to what they want to living local. They are choosing properties where they can walk somewhere. All of a sudden, where you can walk your dog means something. Well-being means something. It means nothing on a spreadsheet. Where do you put on a spreadsheet where you walk Rufus, the dog? You don't, right? So again, I've seen, and the reason I'm flagging this, I'm seeing a lot of clickbait for assets, which I just, I'd be mortified if I owned those assets. I would be, you would be lighting a match to money, owning those assets. And, the socioeconomic status is a real indicator of what is unfolding. The reality is, I think maths is important when it comes to real estate. So are things like building approvals, inventory levels, days on market, vacancy rates, the rental return you can get, the yield you can get in the market, all great checks and balances. Overlay that where someone can walk to some coffee shops, where someone can live in a 20-minute area, where someone can have a humanistic experience by using a scooter to get around, or to walk or get around, or understand the spatial transformation which is unfolding in real estate, which I've alluded to in past podcasts. Just go back to the spatial transformation podcast if you want to understand more about that dynamic. Just don't go and buy real estate where there is an absolute challenge of just no humanistic design or spatial transformation logic. Now, I see a lot of emails, a lot of clickbait, a lot of Facebook of stuff, right? Buyer's agents coming out and going, just secured a great property for a client. They paid, $260,000 and the property rents for $330 a week. And, it's 20 grand below, what someone else had paid for it. And, it's located 94 kilometers from Brisbane. I mean, what the hell? And of course, this is again some of the things you've just got to be wary of when doing this thing called property investment, because there is this, I think, quite often undertone inside Australian real estate in the culture of property investment that, you need to buy cheap and cheerful to become wealthy. Well, here's the tip of the day. Rich people don't buy cheap and cheerful properties. Rich people buy good properties in good locations. And, without question, buying up the best parts of our cities and our areas. So again, into the future, there potentially will be less investors. It's happened in New Zealand. Now, I co-run a business in New Zealand. We've got great property investors buying real estate in New Zealand, but they are an absolute minority. I take my hat off to those investors in New Zealand. They have to put up with so much shit stopping capitalism move in that marketplace. And if anything, it's almost like the government there has become some sort of, Marxist, feed the inequality agenda. There's been so much challenges in that in New Zealand. There's obviously been years of mismanagement of bringing stock into the market. And again, I don't know who's going to provide the stock into the future if property investors don't, but there are things looming, right? And I've talked about this before. Build to rent is a real thing. Build to rent is the idea that big companies, corporations will bring real estate into the marketplace en masse, large mass subdivisions, large medium density projects, and just rent them out. And we are now going to go from competing with, Bob we went to school with, who's also a property investor, for the eyeballs of tenants, with competing with, corporations who are going to fuel the real estate market with stock. And the way I look at that is if I can buy really good, well-designed real estate today, I'm going to outthink the build-to-rent movement, which is absolutely coming. The Australian property market, it can't and it won't be able to rely on more property investors providing rental properties to the rental market to maintain affordability for tenants. Foreign investors are also being chased off. If you're a foreign investor, you're paying a lot of tax, you're paying a lot of land tax. And so for many of the things that have worked in the past by creating, buildings designed for foreign investors that you often see in CBDs, a lot of that stuff is dead. A lot of the Chinese government in China, basically almost like outlawing being a property investor. I think, the Prime Minister or President over there, Xi Jinping, famously quoted that real estate is for a roof over your head, not for property investing. And so I think the era of that huge swing of foreign investors capitalizing the marketplace with stock is also dead. So I think we're going to go through a rental boom into the future. I think between probably late 22 to 24, the rents are going to skyrocket. Then we're going to start to see things change. It could be a rental cap. It'll be build to rent. It'll be slowing down the property investment movement. So if you can buy now, all power to you, because buy when it's easy. I've seen when it's hard. I've seen LVRs drop. I've seen all sorts of things happen. Interest rates go up. I've seen serviceability transformation, the Royal Commission, the APRA credit squeeze. We've been through it all. I've been through it all. I've been doing this for 3 decades in real estate. And listen to someone, I guess, who's been through 3 decades of real estate, what I am telling you is you've got to buy at that affordability and livability supply gap and end up with real estate going in the right direction, or you'll end up in this kind of race to bottom zombie marketplace, which is full of inequality, and it looks great on a spreadsheet. So would I buy off a spreadsheet, or would I spend more time understanding potentially what's nice about a suburb? I would probably spend more time about what's nice about a suburb and what's nice about a street and what's nice about the property, because at the end of the day, as long as the rents are pretty good, you're going to go in the right direction. It's going to move in the right direction. You're going to make money. And if you use my Forex growth plan, you will wake up, if you give that plan 15 years, and you'll be up a lot of money. I'm personally up a lot of money when it comes to the Forex growth plans since I've been using it, which dates back to 2007, and acquired, lots of assets. And, it's like the gift that keeps on giving. That's what I can tell you. And the reason is because with that plan, yes, it's about buying well, but that's not the only part of the puzzle. And I think this is where a lot of spreadsheet buyers go wrong, because buying off a spreadsheet or buying well from a spreadsheet is just the buying well part. What about the location? What about the city? What about the humanistic experience the real estate offers? Real estate is a people business. If people are going to have a better experience with property and they've got more money, they're likely to do very, very well. Now, I was mentioning, regional Australia has been through this, right? I look back on some real estate I bought in regional Australia back in 2004 using a spreadsheet, buying basically with the idea that the yield was a big concept. And today, that real estate it's actually less than what it was worth in 2004. It's gone backwards. And the reason is back then when I bought the asset I'm referring to, it had no nice things around it. It wasn't in a good location. It wasn't in a population, a pie city full of population, infrastructure, economics. It wasn't. It was basically on the wrong side of the tracks in a regional community, and it's still on the wrong side of the tracks in a regional community, and still to this day, owner-occupiers don't want to live in it. And to this day, it's actually gone down in value. Think about that. All the real estate that has gone up in value, and that real estate has gone down in value when measured over the same distance. And I really sort of, I know today sounds a little bit like a conspiracy theory, and, a little bit wild maybe, and not my usual, happy self. I think we have to bow down to the supreme leader of what real estate is. My wife's my supreme leader. She's my North Korea, if you like. I have to bow down to her. We need to bow down today that we need to get into the livability section of the marketplace. And as soon as you bow down to that concept, you're absolutely going to make money out of real estate, right? So real estate is going to be split into, it's happened in regional markets. It's not even I think what we have noticed inside of cities, really since the year 2000, if you like, that ghettos kind of got cleaned up in cities. There basically has not been ghettos in cities for 2 decades, if you like. When I was growing up, when I was going out in the 90s, there was a lot of ghettos. There was a lot of people who lived in inequality. There was a lot of people who lived in houses, and the houses weren't very nice, right? The houses were horrible and smelt like old moths, and things were itchy, and it was just horrible, right? And then I think we've been lucky for 2 decades, particularly off the back of the mining boom era here in Australia, to clean up a lot of our cities where it's not as noticeable when you go through cities to go, well, that's a rich part and that's a poor part. But absolutely, we're reversing. We're reversing, and rich parts will look even better and poor parts will look even poorer. And just because an area is poorer doesn't mean it's going to become richer, which it did do in past eras. And so I think we need to understand in regional Australia, this has been a thing for a long time. You don't buy on the bad side of the tracks, you buy on the good side of the tracks. It feels like to me that in urban buying, we've forgotten that the saying, buy on the good side of the tracks, not the bad side of the tracks, actually means something. It's not, it is a thing, right? And of course, all this is leading to a conversation that, if you're building assets as a property investor, down the track, you're going to have to potentially sell one, maybe two, to pay off debt and keep others which are income producing. Quite often, a lot of property investors are using leverage to control debt, which just fundamentally means that they're taking on more debt to control debt. And so it's like a double debt sandwich. And because it's a double debt sandwich, the worst thing you can do into the future is just invest in this subpar logic, right? We want the better communities, the communities with a vision. And as such, you will do really, really well out of a low rate marketplace where a lot of people in Australia are highly skilled. A lot of Australians are becoming more and more skilled. People are getting smarter here. It's not just an elite section of the market that is going to benefit from this. I'm talking about 50% of society is going to be owning real estate, which is doing its thing, on its way to becoming more and more valuable. And 50% of society will be renters or owning real estate as investors, whereby renters live, which is not going to be a fun part of the marketplace. If anything, it'll become cash flow real estate, and potentially into the future, that will be the way we observe that marketplace as a positive cash flow investment. And I highly think this is, I'm seeing it already in really urban areas. I'm seeing it in Canberra. I'm seeing it in pockets of Brisbane today, that you can actually buy these low growth assets and get a positive cash flow return from them. And if that is your strategy, well, I understand the logic. But if you're buying them with the expectation of growth, it's not going to work like that. It will work, however, as an accumulation strategy of cash flow. So personally, I think what will end up happening is those with real estate assets that get a lot of equity, potentially in 2035 will be circling and back and buying, 5, 6, 7 of these things at one time, and probably doing it just for cash flow, for no capital growth. They will be investors who do not need capital growth, that have more equity than they can poke a stick at. And certainly I look at my equity position since 2007, which I stuck to the Forex growth plan. Like, I don't need more equity. I keep getting more equity from the Forex growth plan. I don't need more equity. And if anything, I should be the one buying these cash flow assets because I understand them. They're not going to create growth. They are just designed around income. And, reason I flagged that is we will have two marketplaces inside of our capital cities, capital growth market and a cash flow market. And that is very interesting because in the past you went cities, capital growth, and then you went regionals, cash flow. That was the two pillars, if you like, of of balancing real estate. Now you can go inequality, cash flow. Where there is no inequality, growth. That is really the formula which is unfolded in real estate. And I think it's so amazing to see this change. You know, I was speaking to a valuer the other day and he mentioned, you know, the old saying, buy the worst house in the best street no longer actually exists in a low rate marketplace. It's actually buy the best house in the best street. And that really got me thinking about today's episode, to be brutally honest, that real estate is going in that direction, that all of a sudden, you know, the rundown, downtrodden piece of real estate is really not what people want. And people today have really transformed. We are in a place of increasing sophistication. We are in a place where people understand the market is moving, the market is changing. And today, you know, people really value the idea of position. And for the people with money, you know, that focus on design is everything, and designing your life, makes people with real estate with, really good assets and the asset allocation behind them just making so much money. If you've got assets that were, $1.5 million, they've gone to 2.2 million. The amount of wealth that it has jumped by is staggering, because again, the position is becoming what people want. And again, I think when we think about this increasing sophistication, it's built around that location, about the strengths of a city. Where are the strengths of a city? Sydney's strength are its harbour, its beaches. That's its strength. So people buying around its harbour, its beaches, and its inner city lifestyle, that's its strength. If you look at Melbourne, very similar. Its strength is its beach or bay areas. Its CBD. It's got one of the best CBDs in the world. And, it's coastline, right? And so all of a sudden, people are gravitating to those spots down at the Mornington Peninsula, or choosing to be urbanites. So you got to play to the strengths of a city. Brisbane is different to Melbourne, different to Sydney. But I just found that so interesting that the worst house, best street no longer really is as accurate as you probably think it is. We are going through a game-changing future, folks. So just think about quality property, quality location equals quality tenant, and a quality resale down this track, no doubt. And that equals longevity in my view. So make sure you stick to those cues that I just mentioned, and you'll end up in the right place. And of course, if you're investing for growth, think about the humanistic experience real estate offers people. As such, you'll do really, really well as we go through this crazy transformation of economics. Thanks for listening. I'll catch you next time on the Urban Property Investor. Thanks for tuning in to the Urban Property Investor. To never miss an episode, make sure you subscribe to the podcast on your favorite app or on YouTube. I would love it if you could give the show a rating and share it with your friends and family. In between episodes, you can always keep in touch with me by connecting on social media over Facebook, Instagram, or LinkedIn. Until we meet again on the next episode of the Urban Property Investor, take care and bye for now.